Hey, Shalom, all praises to Yahweh by Hashem, Yahweh Shai, Bashem Kakadash. Shalom to the elect out there. Yeah, I was just watching this video Apostle Tahar did. He did it 21 hours ago on the silver price. He's looking at silver futures. And yeah, Apostle Tahar's been dealing in gold and silver for a long time. You know, I remember when he first came in, he was talking about silver and how to weigh silver. And all that. He was always into that, you know. But as of lately, I've been studying the market, how to trade the market. And so I'm at the point now where I can tell if a market is going up, whether it's legit or whether it looks artificially pumped up. You know, sometimes they'll pump up, they call a pump and dump. There's a strategy called a pump and dump. Hold on, let me bring it up. Pump and dump. Yeah. Let's see, pump and dump primarily refers to a form of securities fraud that illegally inflates the price of a stock or other asset through false or misleading statements to sell it at a profit, right? And then what they do is they dump it. Once the artificial demand drives the price up, the perpetrators dump or sell their shares at the inflated price, making a significant profit. So in other words, they'll have the market, let's see, pump and dump is, you'll see the price go up, and then all of a sudden, boom, it just plummets. So what happens is the fraudsters, you know, which are they call them the whales that run the market, that got all the money, they will pump the price of the stock up. Everybody's going to buy in. Everybody buys in because the price is going up. And then when it reaches a certain point, then they just drop it. And what happens when they drop it is everybody sells their asset back into the market because now they're losing money. But the thing is, the people that pumped it up, once it got to the point they want to sell, they sell it, meaning they make it go back down. That's selling. So everybody that was riding the momentum up, they thought they were going to make a lot of money. Let's say, like, for instance, like cryptocurrency, right? A lot of people bought certain crypto markets that lost all their money because they bought into the hype while it was going up. You know, let's say, for example, like Dogecoin. So there's a lot of hype in the news. You know, everybody's talking about Dogecoin. So the price is going up and everybody's just jumping in. $10,000 here, $5,000 here. You know, somebody might have put $5, whatever, all across the globe. So the market movers, the market makers, they'll have the price go up, people buying in. They hit a certain point, boom, they sell it. Now what happens is they sell all their stock, all their instrument, all their crypto, whatever the asset is, they'll sell it. And it'll drive the price down. And here are these people that was riding the wave up. They're like, oh shoot, it's coming back down. I got to get rid of it. Either I'll make a little bit of profit, some profit, or they might lose all their profit, but they're going to try to get rid of it as soon as possible. And what happens is when they sell it, who are they actually selling it to? They're selling it to the market makers. The market makers are the elites behind the scene that move the market, that make it go up and down. Okay, everything's controlled. So when they sell it, you're selling it back to the people who's pushing it down, right? So they sold from up here. When it gets down here, you might sell you're selling it to them at a cheaper price, meaning they're making profit. And this is what they do, is called pump and dump, you know? Now this is an illegal tactic, right? I think we just read it here. It's illegal, right? That illegally inflates the price. But this is what they do in the market every day. All right. There's legal ways to do the same thing. But so I was watching this and I'm looking at the market, man. And here's silver, right? So when Apostle Tahar was checking it out or did the video, this was yesterday. It was at 74.97. This was like as you can see here is at when he did it was 8. Let's see, 23 p.m. I think. Down here, yeah, it's about.
Okay, this was
8 p.m. 8:30 p.m. You can see on this thing here. So I'm on this software here now. This is I'm looking at Nasdaq. So if I go back to silver, right now I'm looking at the weekly time frame. This is each bar represents how much silver moved in 1 week. Now you can see silver has been very bullish. Bullish meaning it's been going up. So right here it was kind of flat, you know, which they call consolidation. So if you look at this range here that I'm going to draw, so here, right? I'm going to make this red. And I'm just going in the spirit. I didn't, you know, think of a lesson beforehand. I'm just doing this through the spirit. Okay, then I'm going to, that one's going to be blue. Now see this little channel between here and here. Price was moving up and down in this tight channel. That's called consolidation. There's a reason why they do this, but long story short, whenever you see price moving in a tight channel like this, that means it's about to make a really big move. Either a big move up or a big move down. Now here's the thing. The first move it makes is usually the fake move. So when it does all this, when it breaks out, you have something called breakout traders. Breakout traders, they wait for periods like this when price is moving in a tight channel, and whatever direction it busts out first, they put in a trade. So the people that went long here, meaning they bought here for the price to go up, they're breakout traders. They saw a breakout, they're like, oh shit, let me hop in. So they hopped in. But normally what price does, the first direction it goes in is usually a trap, right? Let me see if I can find an example. Like, yeah, you know, it's going to get complicated if I start pointing out examples. But usually what happens is the initial direction it goes in is a trap. It's to get people to trade the wrong direction so they can go and take all their money. So it's going like this for a little while. That's called consolidation. Then it'll usually go one way, and then boom, it'll juke and go the other way. And you'll see this in the market all the time. And what it does is people down here, they'll put in trades to go long. So it's going up here, and then price comes back down, and they're forced to sell because the price is reversing on them. Or if it gets too far down, then they're actually losing money. They lost money. They got to get rid of it at a loss, you know? So to me, this definitely looks artificially pumped up because the market naturally does this here. Like it naturally does this. You know, it's the ebbs and flows, a natural market. And there's a reason why it does that. I might have to do another lesson if brothers want to learn more about trading, you know. But as you can see here, you know, I was doing this little thing like this, whatever. Like that. And then it just shot up, which is very unnatural for it to do. So what might happen is it might stop and then turn around. Whenever it turns around, there's going to be some type of big news event that happens, right? Because they always have a news event to justify why the market moves. And I wonder what news event or what justification they use for the market silver skyrocketing like this. Let me see. Let me see what the news says. So silver futures saw a significant rally this week at December 2025 with prices breaking past 76.79, driven by geopolitical tensions, potential U.S. interest rate cuts, boosting its appeal as a safe haven, and strong industrial investment demand. pointing a strong buy signal as it looks towards 89 to 100 levels, which is true. Now, after I watched Paulo Soutar's video, I didn't watch the whole thing, and I was looking at this. I said, you know what? Maybe there's about to be a crash, and so companies are investing in silver because, in other words, to secure the money. When the market is about to do bad, what big companies will usually do, they'll start buying up, or smart people, they'll start buying up gold and silver, or companies will start buying bonds. They'll start investing in bonds, and when you see that happening, then something's about to go down in the market. So the market is being artificially pumped up. Either there's legit buying going on, which to me this just looks artificially pumped. Like, look how it's going straight up. It's like there's no pullback. That's not natural. It's not natural at all. Like right here, there's a slight pullback here, but all this, it seems like a trap to me. But we'll just have to wait and see. Who knows for sure? But either they're artificially pumping it up because they want to make it expensive for you to buy. They don't want people to be buying it up. So they're making it very expensive because maybe they're about to do something and they don't want people to have a lot of silver and gold secured. So they're pushing the price up to make it very expensive artificially. Or maybe there's legit people buying it. But again, that doesn't make a lot of sense because this is economics. It's buy and sell. You got to buy high and you sell low. And whenever you see the market do a pullback like this, so here it was going up, pull back, that's natural because what they're doing is they're selling. When they hit down here, there's people that actually bought it. There's people that bought it, and then price goes up, right? And whoever bought it down here, they let it go up a little bit, and then when it starts dipping back down, they get rid of it. They sell it to somebody else up here, so that's where the ebbs and flows in. Somebody bought it, when it came back down, they sold it, and somebody bought it from the people that sold it, and then it went up, somebody sold here, that's why it comes down. Some people bought it down here and pushed it back up, so that's natural, but this whoosh, that right there, yeah. So let me look at let's look at some other. So that's silver. Let's see what gold is doing. Okay, gold, same thing. So this one for gold, it looks a little bit more natural because there's a pullback here, then it came up. So going on a monthly, yeah, but this also is kind of artificial. Yeah, this is artificial. Look, to me, this is a setup, man. That's what it looks like to me. It looks like a setup. So if you're gonna buy, keep your eye on the market, man, because there's no structure. This is just up, up, up. There's no structure that's holding it up. That looks false. So this period here, these little tiny candles, that's the consolidation I was talking about. So if we break this down, it should be like tight little channel. Yeah. Yep. Came down here. Yeah, to me this looks like it wants to drop at any moment. It's a time bomb. So this is gold. Looks like a time bomb. Silver. Yep. Looks like a time bomb. If I go to like, yeah, that's wild. Would I hop in this now? Me personally, I wouldn't. I'd wait for it to pull back and find some type of support, like right here. See how here it fell back and found some support. You know, could have bought here. So, now there's another stock you can look at. I'm trying to remember what it's called. Hold on. Stock that shows market fear. There's a stock. It's like TXXX or something like that. The VIX. All right. So let's look at. We're gonna go to the VIX. Get rid of that. Okay, the VIX. Yep, volatility. Okay, so let's go to this one. Now the VIX shows you market sentiment, meaning if there's fear in the market or optimism in the market. And I forgot for this right here is about to fucking drop. Holy shit. Yeah. Oh, damn, this is about to plummet, bro. I could tell. Yeah. But let me see, when the VIX goes up, is that when VIX... I think VIX might be in reverse. In other words, when you see the VIX drop, that means the market is there's optimism in the market. So let me see. Is market sentiment optimistic? So when the VIX, okay, yeah, okay. A drop in the VIX, which is a volatility index, is generally associated with optimistic market sentiment. The VIX is often called the fear index because it measures a market's expectation of future volatility, which tends to be high when investors are fearful and low when they are confident. Okay. So when a VIX drops, all right, so like I said this joint's about to drop, which means that the market is should do pretty good for a good little while. I'm looking at the daily time frame right now, and I'll tell you how I know, because the structure here is broken. So look, small class right now. So these points up here are swing highs, right? Opposite end, those are swing lows. Now market structure is king. You learn market structure, you can understand what the market is about to do. So we had a swing high here. I'm just gonna loosely mark the high and low points. All right, where there's structure. So there's a foundation here, because from here price eventually went up. Okay. Now, here's the first thing I noticed here. Price came up, the market went up, but it couldn't top this previous level right here. See right here? It couldn't top it. Boom. Could not top that. It failed and came back down. In between this swing high and this swing high, the structure that's holding it up is down here. Boom. This red line down here. That's the structure holding these points up. This right here, it dropping from here, shows weakness. It shows strength is failing, right? Now, once it busts through the bottom with momentum of this structure, this floor, then you know the market sentiment or the market direction is changing, and you could place your bets in that direction. All right. So it happened once there, and I'm looking at the market structure. All right, because the market structure is a skeleton. It's what's either holding the market up or going to push it down. Now, if you look here, right, we had another swing high right here. It came down. Boom. Another swing high that failed to come across that top one. It failed to come up over this one. And if you look, right, the structure between them two right here got broken. Boom. That got broken. So that is a great indicator that we are headed south. So if you're going to play some bets, well, I'm sorry, this is the VIX. So the market is going to do the opposite of what this is doing. This is about to plummet by a lot. So looks like the market is going to do really good. So silver might just be a good ass buy then right now. But even for silver, I would wait for more. I'll wait for more structure. Let's see if I go back to silver. Silver. Yeah, I would wait for some structure. If you do hop into silver, just be ready to pull out. Be ready for it to reverse on you because you don't know when it's going to back up. You know, in stocks, you don't want to call tops, meaning you don't want to guess where the top is. Say, hey, you know, I'll buy a whole bunch and I'll just guess it's going to go up to here. You need to wait for some type of structure first. But if you just want to hop in, you could do that, but you just got to be ready to pull out. You know, just be ready that it could turn around at any time. You know what I'm saying? So there's another stock that's coming to my head for market health. I think it's TQQQ. Let's see, TQQQ, which is a stock. Yep. All right, so this one is another one you could track market sentiment. Let me look, hold on. Is TQQQ inverse to, what's the one we just looked up? VIX. Okay, so TQQQ isn't directly inverse to VIX, but they have an inverse relationship. TQQQ thrives on low volatility for big gains. Okay. So when TQQQ is up, is this optimistic market sentiment, which should be yes. Yes, when the TQQ is up, it generally reflects optimistic bullish market sentiment towards technology, really the NASDAQ. So what you could do, excuse me, these are called inverse assets. You know, inverse means when they're going in opposite directions. So TQQQ, it shows up. So, right? Yeah, TQQ, let me see. Is bullish. All right. And then I think I go here. And then here I could go VIX. And then you got the VIX. So what you do is you look at these to confirm if you want to put a trade. So if this is going up and this is going down, then it's a good time to put a trade. So for me, this is definitely like pushing up. This one here is kind of flat a little bit. I already know which direction it's going, but still, right, currently sees a little bit flat, a little bit. So I would wait for this to match the same momentum as this. You can see this has momentum, right? It's just like, right? Bust stuff. It busted up above this swing high right here. It's just like, pew. This right here is kind of like dribbling down. So I would wait for a little bit more push down to kind of match how this looks. And then I know that the market is definitely headed up in a strong direction. You know, when this is kind of dribbling a little bit, it makes this one to start dribbling. See how here is dribbling? See, it was going strong, and here it just started. It started. Well, again, it's called consolidation, right? It's just consolidating. I'm on a weekly time frame. If I go down to like an hour, you can really see the consolidation, right? So let me go from 1 week to 1 hour, and you can see how it's just like it's not really going anywhere. It's just kind of like dilly-dallying sideways because it's matching this one here. It's kind of dilly-dallying sideways. But this is going to drop. So probably next week, you're going to see a nice drop here. And then once this one starts moving, you're going to see this one start moving too. And vice versa. You know, they move at the same time. They just move inverse of one another. You know? Yep. So that's it, man. I trade futures. That's what I like to trade. I trade futures, and I'll do like, yeah. See, that's my markings. So right now, the NASDAQ. This is NASDAQ futures. So NASDAQ is bullish right now, but I believe that once we get like up here, I'll really know whether it's bullish or not. I definitely think we're gonna come up here. So I think short term is definitely bullish. But once we cross here, you know, and get into like this little tiny box I'm about to draw, right there, I will not be surprised at all if we get a huge drop from there. I'll be looking out for it. You know, I will be looking out for it. So when the market price reaches up here, if it has a close strong beyond this line that I drew, then I would look for it to keep going up. If it kind of slows down and has a really weak close above this line, we're most likely going to see a nice healthy pullback, you know. So anyway, like I said, man, I really had no agenda for this lesson. I saw Apostle Tahara's video. I just wanted to do a quick look at myself, because I look at the market structure. You know, they call it naked charts. I just read the naked chart to try to figure out what's about to happen. And with silver, I can't call it because there's no structure. It's just kind of like wilding out right now. You know, this is the daily. So if I were to trade it, let me see if I were to trade this, would I have taken this trade? Let me see. Today's Friday, right? Today's Friday. Now the cool thing about this tool is called TradingView. You can rewind days. So that's Friday. Let's go to midnight and see if I would have caught that trade. This is Friday. I'm looking to go to midnight. Jeez, come on. I'm on a 5-minute chart. That's why it's taking so long. Okay, so midnight is there. This is Thursday midnight, which is beginning of Friday, right? So let's fast forward a little bit. All right. So midnight. Now, don't mind me. You know, like I said, I do trade, so I have my way. I mark the charts up and stuff. So just bear with me. If you're bored, you could shut the video down. So this is a price that silver was at on midnight, Thursday evening, midnight. It was $74 and $74, $8.30, right? Let's see when Apostle Tahar saw it. He saw it at what price was it again? He saw it $74.97 at $8.30. Okay, so it went down a little bit at midnight. Okay, so then what I do is I'm gonna just fast forward. So let me put this to like um, 1 hour. I'm gonna fast forward to 8:30. We're in futures. Futures 8:30 is when the market opens. So this is 2 o'clock, 6 a.m. Damn, look at that drop at 6. All right. See, this is what I was telling y'all before. See this right here? This is consolidation right here. See this tight little channel? It's not really doing shit. That's called consolidation. All right. I'll draw a box around it. It came up here, then it just kind of did this little sideways shit, not really going anywhere. If I go to 5-minute chart, see? Ain't really doing shit, it's going sideways. Now see how it faked the move? This is a trap. So it does all this BS right here, back and forth, consolidation. And then, boom, they pump it up. And the breakout traders are like, oh shit, it's going up. So they hop in. They hop in with a lot of money. And it's going up, it's looking good. And then, boom, it reverses on them. All these cats just lost all their money. Reverses. And then sometimes what it'll do, a reverse, it'll go down for a little bit. And then it'll juke, come back up again, boom. Now these cats that are going short, they lost all their money when it reversed. So it's kind of a big game. But yeah. So and they all do that to generate something called a liquidity, excuse me. You know, you need liquidity to move money around. All right, so boom, this is what I would have did, right? Let's see. So I got to do my markings, right? Now the cool thing about futures, unlike the stock market, futures is basically 24/6. The only day it doesn't open is Sunday. Only day it doesn't open is Friday at 6 p.m. until Sunday 6 p.m. is closed. Any other day, any other hour, it's open. So you can literally trade almost 24/7. Almost. All right. So now because it's almost 24, it runs 24/7. Sorry, hold on. I'm trying to figure something else here. Okay, that's 5. Because it runs 24/7, the whole market trades this. You know, China is trading. So from 6 p.m. to 2 a.m. is when the China market is open. Right? So they call that the Asia session, Asia high. And then this would be Asia low. So all I'm marking out is the highest and the lowest points during the Asia session, meaning when the market was open in Asia. And people in Asia are trading while people here are sleeping and they just got off of work and stuff like that. Over there, they're just starting to trade. So at 6 p.m., actually 6 p.m. is down here. Okay, 6 p.m. Thursday. All right, and then Slack channel, this is boring. And then after Asia market closes at 2 a.m., then London opens. London opens from 2 to 5. Boom. Okay. These are very important to know if you're going to be, well, trading how I trade. All right, you got London. So London. So me, what time did it start going down? At 5. Once I saw this here, this move, I would have already been anticipating price going down. So I don't know if y'all can see it, but down here is a little gap. So I immediately know price is probably going to this gap. All right, another video again. If brothers are interested in this stuff, I'll do more videos so you can learn how to trade. But When you see gaps like this, is a magnet for price, right? So I'm looking for price to start making his way down here, which he already did, right? This strong ass move down. Okay. So now it's 8 o'clock, and the market opens at 8:30. So what happens is the New York market is usually trap people going the wrong way. So at 8:30 when the market opens, whatever direction the market is going is usually the wrong direction that it wants to go in. It's a trap. Again, the market is full of traps, and there's an algorithm that runs it, and there's a lot of traps and shit in there for people that trade kind of like how I do, scalpers and swing traders and short-term traders that get in and out of the market. So right here, I would not make a move yet. So I'm gonna act like I got here at 8:30, and I'm just like gonna trade silver. So what time? Now it's okay. Now it's 8:30. So right now, let me see. Would I make a move? Would I bust a move? I might bust a move. I see this. Right. And then I'm going to go down to the 30-second time frame. And yeah, I think I would definitely take a trade. I'll tell you what direction. Not yet. So I'm acting like this is real life. I wouldn't take a trade yet. Not yet. Okay. Here I might take one. Let's see. We're on a 30-second. I might take one here. Okay, right here. Let me buy 3 of these bad boys. Now I'm simulating real trading. All right. Here I would buy. Stop loss. Okay, so this is how people trade, right? They think it's going up, and they say, look, the trade goes backwards on me. When it hits this point, just get me out of the trade. So basically, I invested $750. If it hits down here, I'm basically selling it back into the market for $750. Now, whoever is up here, let's say somebody bought up here, whatever, at this price, $74.90, let's say $74.94. It's over here on the right, the price. If somebody bought up here because they knew it was going down, and they are selling, and this hits my stop loss down here, basically, whoever bought up here, I just sold to them at this cheap ass price down here. Because once price goes backwards and hit this, I'm selling it back into the market for $750. So up here, where somebody could have bought up here, let's say they sold from up here, that's $6,150 worth of silver. And let's say the market makers send the price down, all right? Me, because I'm in here scalping, thinking like, oh, I'm going to make some bread today, I see this here, and I'm saying, you know what, I'm going to buy here, and I'm going to get out somewhere on top and make some profit. What they'll do is they'll let it run up like this to trick someone like me, like, okay, good, I traded the right direction. And then, boom, they'll reverse it, send it back down, and hit my stop loss. And basically, whoever was up here and sold it down and it hit my stop loss, they made over 6 G's in profit, you know, because I sold it back to them for $750. So that difference is what they make in profit. Lord's will, that makes sense. But let me see. So with that said, I'm not gonna buy it yet. Let's go. Probably could have, but I'm not. Yeah, see, I would have got out. I would have got trapped right there. See, that was a trap, and I would have got hit. $750. It's a good thing I was wise and got out. So see. So as of yet, I wouldn't have taken a trade. Nope, still wouldn't take one. Okay, here I would take one, even though it's still tricky up here. Yeah, this is tricky, but I'm gonna buy. And I'm gonna buy. I'll probably suffer some drawdown, and I would get out. Could get out up here if I wanted to, so I would get out up there. So that would be what, like almost $12,450 if this works out of my. So I'm down $800. I'm okay. Oh, I was just in $1,200 profit. Okay. All right, now I'm $8,000 profit. This is how people make money in the market. Boom. So, so if I was trading this, right? Doesn't give me the amount I just made. I just made like 6 G's, over 6 G's. You know. So if I was trading this, that's a trade I would have took. And that's how people make money in the market. So I essentially would have got on at 8:30 a.m. Now I would have waited, and by 10:30 a.m. have 6 G's in the bank. You know, but my main point of doing it was showing you why they do this up and down, because they trap people and they come back to get them and make profit, and then they can move it up. Right? They got to make money first. So then now they got some money. Now they can move it up. That's called liquidity. You know, so when you see this, you know, like this is what it looks like now. Yeah, this. Yeah, there wasn't really no healthy pullback. It's just a straight up whoop. So it's gonna pull back at some time. You know. Here we have another more sideways motion. See how these are going up? Right here is sideways. You know. So this might be the fake move. It might do this. Boom. This is what I would expect. The only thing is don't know is how high is it gonna go? How much higher before it turns around? That's the only thing. But anyway, I hope this was a little bit edifying, you know. So shalom, all praises to Yahweh, Ba'ashim Haushai, Ba'ashim Karkadash, shalom.